As we've already described, the bull market continues. We're in the longest ever bull market by most people.
Only in the United States.
Only in the United States, but I was going to say there was some dispute about it outside the United States.
Yeah.
And I think the key thing is going to be looking at the Q3 and then obviously the Q4 earnings season to see whether the momentum that we saw in Q1, Q2 can be continued into the latter part of the year. And it seems to me that the political noise, particularly around trade, is going to continue, and it's less hard to see how companies can continue to deliver the type of earnings growth that we saw in the first half of the year.
Which means sell-down positions?
Yeah, which means it is going to be
bonds?
harder for equities to retain the momentum they've had in the first half. We've had a terrific first half. Is it going to mean that will continue in the second half? That's the big question.
We had a brief conversation off camera about high net worths and what they're doing and the problems they're having finding anywhere else to go. Why not stick with the momentum trade? Why not stick with the equity market regardless?
We always say to our clients, you've got to be invested over the long term. Markets will have periods of corrections, and the key thing is not to try and time those corrections and to stay invested. Trying to say when you should put money into cash, we've always considered this to be a fool's game. Just look at 2016.
Ready?
I agree entirely. So from an equity perspective, we don't try and time our allocation to equities at all. I think in terms of where we are in the cycle and how we think about justifying it, I mean, one argument is obviously the fact that there is momentum in it, and that is the way a lot of people who think slightly shorter term will invest. But I think avoiding that and trying to think long term and looking at value, if you look at equities versus bonds and you think of some sort of simple model around earnings growth compared to sort of corporate bond yields or something, equities to me look relatively fair valued still. Now that's fair valued using a very low discount rate compared to history. In other words, your expected return from here is quite low. So I think your expected return over the next 5-10 years from equities will be much lower than previous cycles. But I don't think there's a huge overvaluation risk compared to other asset classes, whether that's principally bonds or property or anything else you could invest in. So maintaining your equal-ish weight exposure would be my core advice at this point in the cycle.